Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. I am sharing my screen. If you're in the Wook Capital Discord, you can follow along live. Otherwise, I'll do my best to read things aloud. Let me go ahead and pin the newsletter thread here. You can also follow the link in our profile to access the newsletter, which I have up. It came out a little bit later today than usual, just due to a little technical glitch. So, okay, I'm just trying to join my personal account and here, see if that'll lure some other folks in. So Chris, my plan, because right now it's just you and I here on the speaker panel, will be to maybe go through each item. So I'm going to start off with a little bit of an intro of just some what's going on. We had our book club series. Our monthly book club series was earlier this week on Tuesday. We had a great discussion, a bit under 2-hour runtime on One Up on Wall Street by Peter Lynch. So even though it's a 34-year-old book, I think there is a lot that still holds true to this day. I'm going to pin that here to the spaces. It's also available. It's not yet available on our YouTube, but it will be shortly. But I do have it pinned here as well if you want to check that recording out at a later point in time. So we had that. We had our open mic on Wednesday. Last week we talked about where are things with regard to the debt ceiling situation, and we've got a resolution now. We've got a bill that's passed both houses of Congress. The president's office has said that he'll sign it as soon as tomorrow. So America has successfully staved off default, although for the time being, we remain one of 2 countries in the world that has this silly ex post process by which we have a debt ceiling that we agree to spending beforehand, and then we have this silly self-imposed limit. So hopefully that aspect gets resolved sometime. It's obviously not going to resolve this time, but that risk is now off the table for some failure of Congress to address the debt ceiling. We got a lot of economic data this week. We got, as the month starts out, we got some purchasing manager indices. We got a jobs report today. So a lot of economic data, which we, to the extent people wanted to talk about, we are happy to. But I guess so I just mentioned the book club. Let me go through kind of our highlights from the newsletter. So yesterday, Lucid, which we have on our Wookie watch list, and we've talked about a few times, raised about $3 billion from its largely from its Saudi minority owner. So this is a continuation of what we'll probably see for a long time now. A lot of these electric vehicle makers are, it's a very capital intensive business, and while there's still appetite to fund, in the case of say Lucid, with the Saudi Public Investment Fund (PIF) providing the majority of that investment, it's still a brutal industry that's historically not seen impressive returns on invested capital. We've got so many of these startups that, of course, came public over the last few years that have just not come anywhere close to the to what they had asserted in their SPAC documentation of what they expected to sell, and from a sales and profitability perspective. So I feel like it's a good example of yet another SPAC that's you know in the case of Lucid stock, it's only down. I guess you have to consider the dilution, but it's only down to 660 today. Of course, SPACs, most of them started at $10 per share, so it's not among the worst performers by any stretch, but it's just one of many that were very hyped. Of course, for those of you who remember Lucid, during the early 2021 mania period, before it had even announced the deal, ran up 5 times its the cash value of the SPAC. So this is just another interesting one. It is an upscale luxury EV maker. From everything I've read, they do have some impressive electric motor technology in the vehicles, and what the final outcome for the company ends up being is still unknown. But all of these electric vehicle makers and automotive companies in general are competing. It's a very cutthroat industry. We saw it was either earlier this week or late last week, that Ford has now signed on to tap into the Tesla supercharger network. So we still have inconsistencies around the charging standards that the vehicles are being manufactured with the Delta from the CHAdeMO that's used by a lot of the Japanese OEs, the combined charge standard that a lot of the legacy OEs and European OEs have leaned on, and then of course there's the Tesla standard, which is on its own. So electrification, just again, even if we were to agree with the statement that eventually the majority of automobiles sold globally, or at least in developed markets, will be electric, I still go back to that it doesn't necessarily mean that industry is an attractive area for invested capital. But going back to the story in question, Lucid is successfully been able to keep raising capital from Saudi for the time being. So just to step back, Chris, I got you up on the speaker panel. Mondiv, I see you joined. You're welcome to join the speaker panel. Anyone in the audience who'd like to chime in. My plan for those who haven't joined these discussions before is to kind of walk through the stories and concepts that are highlighted in the newsletter itself, which I have pinned in the thread here. And yeah, I mean, happy to talk about Lucid in particular, electrification in particular. It's always a fun topic to talk about, and yeah, we'd love to hear what you guys are thinking. Do you guys see Lucid or Rivian or any of these EV startups ending up paying a good return to investors over the long run?
I'm not super optimistic about a lot of these EVS packs, especially Lucid. I mean, they're like very catered to the high price segment, and they're selling sedans. And, they don't really have much of an advantage when it comes to battery technology and manufacturing. So they're going to need a lot of more investment if they want to compete.
Yeah, it's just such a competitive industry, right? And the incumbent OEs, of course, have talked for some time now, whether it's Ford or General Motors, about the challenges of getting to operating break even on the electric vehicles that they sell. Which, again, anyone listening who knows me knows I'm not a big fan of Elon Musk, but I will give credit where credit is due, that what the team at Tesla has done, and not just Tesla, there's other OEs, especially in China, that have made some great strides in the manufacturing side, especially BYD, which Chris, I know you're a fan of. But the actual process of assembling these vehicles, the components that are important in these vehicles are just simply not in alignment with what the engine itself, right? That's what most of the traditional OEs are really bringing to the table from a value add. They're assemblers, They have some proprietary engine technology. That's what their engineers worked on, and there's not really a direct line between all of the investment that Daimler and General Motors have made in internal combustion to electric motors or to the battery side, which really that's a big piece of it because the battery is still the biggest cost item for the electric vehicle, and so it's kind of a simple factor of what is your battery pack cost, what is your loaded cost on those battery packs, and we've seen this ongoing trend toward lithium iron phosphate LFP pack modules and cells going into the packs, which is dominated by China. The BYD Blade, I think Chris, you're familiar with that, has gotten great feedback. The old LFP batteries underperformed in cold weather. Didn't have as much power. There were some, any chemistry difference. Like there's trade-offs. There's pros and cons to all of these battery chemistries, but what does seem to be a trend that we're likely to see is that in non-performance vehicles, in economy cars, a lay person's EV, it seems more likely today than it did a few years ago that the preponderance of vehicles on the road will be outfitted with the lower cost, because you don't have the rare earth metals in the same, rate. You don't have cobalt in an LFP battery. You don't have to worry about, the high costs of nickel, manganese, cobalt, lithium to the same extent. So these LFP batteries continue to kind of get through the industry. Going back to Lucid is a positioning itself as a luxury, a premium automobile. Same with kind of say Rivian. They're not going to be producing, I think. If you're trying to sell a differentiated product, I don't think you're going to put the LFP packs in those vehicles. But Tesla's seen success, right? They've put the LFP packs in some of their Model 3s, especially I think that in China. And I don't think, at the end of the day, the consumer doesn't, most consumers don't know or care about kind of those intricacies. They want a vehicle that's reliable, that's low cost to some extent, that fits their needs. But yeah, I mean, we're in this environment with higher
Hmm.
interest rates, with demand on the consumer side somewhat declining. It seems for automotive. In this, if you believe we're in the late part of the cycle, like I do, you would think that it's not a good time to be investing in automotive. But if you're of the view that we're actually just maybe beginning a new bull market, and that the consumer is going to be stronger than people had thought, which it has been broadly for last 6+ months, then maybe some of these legacy OEs actually, like your Stellantis, your General Motors, your Ford. I mean, Stellantis trades at a 3 times forward earnings, right? The maker of Jeep, Peugeot. Stellantis is the Chrysler plus Peugeot entity. So there's it's an industry that I don't think you need to be invested in directly, right? If you want to get exposure to the long-term trend of vehicle electrification and what that means, I think it, just like with AI, you're better suited looking in like the picks and shovels type plays. Maybe you look at you know, for example, in South Korea, they've shifted things around with some of the um, I think it's POSCO M now is the entity that's been spun off from the steel maker that is now focused on the precursor materials that go into all of the battery cells and then modules and then packs. Right, a cell goes into modules, modules go into packs, and that precursor material is in all of the, depending on the chemistry, right? It's going to vary what the mix is that goes into that material, but everyone is going to need it, right? And I'm not saying POSCO M is the one to pick. I'm just citing them as an example of, I think, look throughout the supply chain for some stuff. Maybe you don't want to select the shiniest of objects, the ones that get all the headlines, the actual assemblers themselves, and instead there may be some interesting opportunities in the supply chain. However high up or down you want to go, right? I think we talked in the past about rubber tires, right? Tires, all else equal, are consumed at a higher frequency. For the same number of miles traveled, a there will be higher replacements of tires. So that longer term, this shift to electrification and autonomy could be very bullish for the Goodyears and the Michelins of the world. So yeah, I love talking about EV. I think it's clearly super interesting. But I think a lot of times people get focused on the shiny objects and maybe less so on the boring stuff that again, it's not sexy to invest in a cathode material producer. It's not sexy to invest in a tire maker. It's absolutely sexy to buy Lucid stock or Tesla stock, right? But yeah, Monative, thanks again for coming up. Chris R. Monative, I don't know if you guys have any thoughts or pushback on my little narrative there on EV.
Yeah, I think I heard that BYD and CATL, which are the two biggest EV battery producers in the world, manufacturers, they are building sodium ion batteries, and they're going to have them in cars delivered by the end of 2023. So sodium ion batteries, they don't require any lithium at all, and they will be much cheaper in terms of material cost. And the energy density is not as good as LFPs, but I think they charge a little bit more quickly, and I think they can last quite a while as well. So I think for the budget EVs, if you're going sub 20K,
Yeah, I'm looking at a story talking about the sodium ion batteries, and if you're talking about a mileage of, like, let's say 100-mile range on the vehicle, so you're going to have a trade-off there, but obviously, by, as you noted, taking the lithium out of the soup that's going into the pack, that lowers the cost. Which these might be almost like a refreshed version of the Nissan Leaf, right? The early Nissan Leafs had pretty low mileage, but it goes back to use case. If you're a city dweller, you don't do too much mileage. You don't need a long distance vehicle. Perhaps that fits your needs, and that could be sold at lower cost, right?
Yeah, and I think investing domestically in the United States for a supply chain for these kinds of batteries, I think it should be a national priority.
Well, clearly it is, right? The Inflation
Yeah.
Reduction Act, has steered significant capital. I know we've talked about that on past Wook reviews about
Mhm.
the shift of European-based investment, or even uh, elsewhere in the world, into North America. We talked about, I think, the big plant for VW that's going to go in Canada, the big one the Canadians brought on board. That. So I saw someone share a chart of construction investment, and it's surging, and a big, I think, component of that are some of these industrial policies the U.S. has undertaken, the CHIPS Act on the semi side and Inflation Reduction Act on the battery kind of supply chain and EV side. And I'd love to know if you guys have seen any breakout, because I'd love to know, like, how much of this surge in construction is fiscal stimulus from these policy choices versus just maybe again the economic cycle being at a different point than one would think.
Come again, Rod, on the last point I missed.
Monmouth, that construction spending is surging, or construction investment is kind of surging. I saw charting earlier this week, and I said to myself, like, how much of that is coming from CHIPS and IRA? Like, is it a small portion? I mean, I see the numbers, like, on their face, pretty big numbers for all these different battery plants that have been announced over the last year. And it feels like there's a new one every day or every week. So clearly there's been an uptick in incremental investment stateside and in allied countries, free trade countries, because of IRA and obviously for chips, it's I think specific to the U.S. But I don't know if there's anybody who's done an analysis on like what mix of the construction spend is coming from these policy support programs.
So, I mean, at a high level, none of these plans are economically viable without that incentive, right? So clearly, the only reason why companies are willing to put a plant here is that they're getting part of that initial capital cost from the government as an incentive. And second, there is pressure to locate companies outside China. So they also know that supply chain disruptions could cause them to lose production, for extended periods of time, especially if geopolitics worsens. So I mean, while they have plenty of reasons to do it, they still won't do it without that incentive in place, right? So whether it's here in the US or Canada or Europe, it basically comes down to who's going to shell out the most money to cover most capital cost as a percentage for a plant to be located. And you're seeing that clearly in two steps, right? One is, first the selection of the country itself, right? I know Germany and US have been at the forefront of, doling out money to bring these sites in, and Canada now trying to, compete also. And then on top of that, the states are offering additional incentives to locate it in their, jurisdiction. So companies can, get even more incentive, whether that's tax holidays or free land or whatever else, right? So I would have to believe that at least significant double digit percentages is covered by of the capital cost is covered by incentives. I don't know, it could be as high as 50%, I suppose. I doubt if we're going to fund anything beyond that. But in addition to that, what we've seen, in addition to the incentive to locate production itself, if you take the case of Tesla's battery packs, there is a substantial subsidy on the pack itself. So not only is production being subsidized for the manufacturer, but the acquisition of the output of that production for a end user is also being subsidized. So it's all the
Yeah,
way
it's
down to
35 kilowatt hours, I think, right? For I just Googled it and that's what it looks like, which is a pretty huge number. If we recall just a few years ago, Tesla had already gotten costs down toward 100, right? So that's a meaningful subsidy. We're talking about roughly a third, at least in the case of Tesla, give or
yeah.
take, of the cost being just a pure subsidy.
Yeah, so if you add it all up, we could be talking about half the cost or more being subsidized.
Yeah, and one other thing that was notable with the IRA, if I remembering right, is that there's no cap on a lot of these subsidies. So it's not like there's a limited pot for the various members of the supply chain and automotive community to tap into. So it's clearly led to a lot of activity. It's not likely going to change unless there's I guess a political shift. And it has led to these, I don't want to call them price wars, but incentive wars, where the U.S. is competing with Canada. Different states are competing with one another, as you noted, to attract the investment, and they're having to shell out a lot of tax subsidies, which gets back to the point of, is this a sustainable thing in the absence of those, and how much risk is there if there were a policy change to making these big multi-decade investments.
Did you see Trump's speech the other day? He was taking shots at electric cars. He was saying that you drive them for
Chris,
an
you know
hour
me
and a
well
half,
enough to know I didn't watch that.
But I thought it was interesting, right? Because like he was criticizing Biden for giving too much support to electric vehicles, and of course it's a Trump rally, so like everybody's amped up, and but I think that's interesting, right? He doesn't really like them. I guess like when he was in office, Tesla still had gotten a lot of varied government support and subsidies, but it wasn't like a big proponent of his policy. Whereas with Biden, right, it was he had this whole act. Um, but I don't know how much that would really change if there were a change in political party running the country.
Yeah, you'd need a pretty substantial Republican majority and control, I think, to pass a bill that pulled that sort of that adjusted IRA in some capacity. Um, I mean, look, there's real reservations with EV, and I've made this point that as somebody who's driven electric vehicles for most of the last decade, uh, there's some very serious downside issues where the residual values of these vehicles, the risk to a consumer, the used car buyer, the person buying the average vehicle on the road is more than 10 years old. So when these vehicles get older, which some of the earlier ones are, buying them outside of warranty is a very dangerous is very dangerous for the consumer. If you have a battery module fail, a lot of these components are going to lead to the vehicle being totaled. I made the point that I had a first generation Chevy Volt. The battery module failed. Thankfully, it was still under the warranty, which for many of these, if you're outside of California, it's, I think, 8-year, 100,000 miles is kind of the norm. So once you get past that threshold, though, which again, the majority of vehicles on the road are older than that threshold. So down the road, I think there's a lot of concerns that I have around what it means for consumers. If you buy a used Tesla today that's outside of warranty, it's not just Tesla, it's all of them. You're at risk, and of course this can happen with an internal combustion engine, right? If your transmission or your engine fail, but the costs of repair and replacement outside warranty is just astronomical. And I just think that that's something that maybe policymakers have. I don't know. I guess they don't care about that really. They're more, they care a lot more about the environmental messaging up front rather than some of those other considerations. But again, going back to the broader concept of longer term, that therefore means there's a lot more recycling opportunities within, whether it's recovering the valuable battery minerals and materials that are inside of those cars that get totaled. There's a huge ramp in the coming decades for all of that, but it gets back to, is it a good investment today? And there's been a lot of startups that are going to burn money for many years, and some of whom may not survive to get to the day in which we see a very meaningful battery recycling industry take root. And is that industry going to be based in the U.S.? Is it going to be ex-U.S.? Just based on kind of the cost of transporting those materials, you'd think that we're not going to send container ships full of old battery packs back to China just to send them back here, but who knows? So yeah, there's just a lot of different considerations that go beyond the car itself or the OEM.
And if you subsidize the packs enough, right? What is that takes away some of the incentive from recycling. So it's sort of counterproductive. But going back for a second to the earlier comment about regime change, look at where these plants are being located. Are the Republicans going to shoot themselves in the foot and take it out now? IRA running out of money is a different story, right? I mean, but until that money is all spent, by which time most of these sites should be up and running, and they're up and running in Republican states. Are they going to cut them off and say, what, shut it down? This is subsidies rarely ever get taken out.
Yep.
Once you give them out, you never take it back. I mean, we're still subsidizing farms for what, better part of 100 years now or more. It's not going away.
Yeah, no, your point is very good, Monative. It seems like the skew, just because of lower labor cost, is toward locating these facilities in whether it's the Southeast or Tennessee, Georgia, Carolinas, states that are generally not unionized, have lower labor cost, more accommodative policy. Um, so you're right. Are they going to shoot themselves in the foot? Who knows? But the likelihood of a full repeal of IRA definitely strikes me as very unlikely. Whether there's a scheme in which some of the incentives end up being capped, I could see something like that. But yeah, I would agree with that sentiment.
It's the same story with debt ceiling, right? People are swearing up and down that the defense budget was going to get cut. Have any of these people that were talking about it looked at where these manufacturing sites are? Alabama, Louisiana, Texas, Florida. Which senator is going to stand up and say, you know what? Hey, I don't want that tripling of production capacity and 3 full shifts in my city. I'm willing to lose that, for the sake of, holding the budget down. Not one time has it happened in history. This is, I mean, this political chatter, and then there's the practicality of the situation and their own, funding and well-being in place, right? None of these things really happen.
Yeah, it's a good point. It's a lot easier if you're, say, a Republican senator from one of those states that's receiving a lot of this investment when you're out of power to say, we don't like this spending and we want to get rid of this. It's a lot different if you were to be given the reins of power to go and disadvantage your constituents. That's just not something that a politician is likely to do. To circle it back to recycling, I'd seen McKinsey had a good little thought leadership article that they put out in March, so it's pretty recent. This was them sizing the growth of that recycling for all the battery componentry and scraps. So they're seeing a 25% CAGR through 2040 from 2020 levels. So pretty massive growth. We're talking about going from 50 kilotons in 2020 to 20,500 kilotons by 2040. What is interesting, going back to the recycling nuances, is that right now in the production process, when Panasonic, at the Tesla Gigafactory is making these, cells and modules, their scrap rate might be in the single digits, around 10% perhaps. When these new facilities come online, especially in the first year or so, those scrap rates can be up to 30% or more of all that valuable metal and rare earth material, not being, not reaching final product. So for their sizing, they see, by 2025, the mix is about a little bit more than half of all of the material would be production scrap. Even by the end of the decade, still about 43% of the material will be production scrap. It's not until you get into the 2030s and really by 2040, in their estimation, it's 94% of that material, that large number, would be end of life batteries. So right now, it's mostly just all of that production scrap. And if you joined us a few weeks ago, we talked about a company, Recyclico, that is a speculative pre-revenue company that has a recycling process. But I think it was Wook Review 31. But either way, I don't want to rehash that discussion. But it's so interesting. It's such a massive change. There's so many moving parts to it. But that again, the recycling itself is going to see a 25% CAGR for the next 2 decades, per McKinsey. Okay, so that's a lot of talk about EV. Jumping off of the Lucid thing, I had included in here, so in the newsletter, some graphic from the JOLTS report we got earlier this week. So I mentioned earlier, we of course got the labor report, the non-farm payrolls report this morning. I mean, I won't go through all of the details, but in a nutshell, I think it's it's very clear that the economy, and we said this, I think, several times now, that the economy was in better shape. The underlying economy's health was in better shape than many people thought, myself included, going back, 6, 9, 12 months ago. And you see continued strength in hiring. You see some, cooling, right? Quits rate coming down. Openings did tick back up. To this morning, we got an uptick in the unemployment rate, even though we had significant job ads. So, like in the short run, there's a lot of noise depending on which data point you're looking at. But I'd say on net, it really looks like you have every week that goes by, the likelihood of the soft landing narrative seems to rise. And I would say broadly, I think financial markets have been pricing that in, and perhaps they sussed it out. I know, Jiro, you're listening, and I know it's late where you are in Europe, but would love to hear if you had any thoughts on that. Monita, the same, same to Chris.
Hey, sorry, I didn't catch that. I was distracted by something else on the computer, just shutting everything down after the day. I'll look, the entire employment data, I think, is going to continue to be patchy, positive, very positive to very negative, because we're still in very unsettled times. I think the data is messed up. I wouldn't read, 1 or 2 or 3 readings. I just, the trend is probably the closest you're going to get to the truth. So I'm not sure, I see any policy change based on what, at this point, in fact, any data point, I think, consistency is probably going to rule more than the data itself. So I'm not sure I see anything changing from the massive beat in NFP, which probably the next time we get it might be a negative surprise, and then
or a
you
revision,
even
or a big
yeah,
revision,
exactly,
right?
or a
Which there have been
revision,
a lot
right?
of.
Yeah, of course, right? So I think, well, we can always say, it would be nice to get good data, but we can only hope for consistent bad data, if nothing else, right? Same methodology, same way of measuring, same way of calculating it, same time gaps, things like that. So I think this year, and certainly the rest of the year, is going to be all about is there a directionally true signal, and is that strong enough to verify the direction one way or the other, right? And Fed is going to be in a in a tough place. It's like, can they really go ahead and increase their rate based on last week's data, or are they going to be swayed more by next week's data, or the day before, or the CPI that comes out the day before their meeting starts, right? Which they should, as Powell said, he's going to be able to receive critical data if it's coming right at their meeting. They probably will get it the day before. So I think it's going to be a struggle. So the question is, the strength of the trend overall that has been established, whether let's say, we're, CPI is at 5 and falling, I think an outlier that takes it up to 5.6 should really not, derail, their decision, nor should, a sudden, 3 handle, if it comes out, it's probably, still to be questioned. My take on all this is that they should not increase automatically, even if it goes up. I think they should wait. I think they've done enough, and there's still a significant lag. Whether they do that or not is a whole different story. But I think the easy increases are done. Now they have to earn it. They have to really justify it, and I really, really hope there is a dissenting voice, irrespective of the decision. This unanimous, easy, yeah, we'll just do it this way is crazy. I don't think they're really talking at all. They just rubber stamping it.
It did sound like from what the speakers had to say this week that the market's coming around to this narrative of they will they will skip or pause, whatever your adjective, I guess, that you want to call it, this June meeting to see more data, and that's what the market, it looks like, is pricing. It's, right now, as of this point in time, 2/3 chance of no hike and a 1/3 chance of hike, which is a flip flop from a week ago. So it seems like the Fed speak had some of its intended effect. I know it was earlier in the week. I think one of the speakers kind of you saw it in real time after his speech, a changeover. So yeah,
Yeah,
we'll see.
what's the worst that can happen, right? I mean, we've had a history where they've done rate hikes, off cycle if necessary. So what's the worst thing that can happen by waiting? Nothing at all. It's just the focals of what it might lead the market to think. I mean, if that's what determines policy, then we've got bigger problems.
What I and Mickey, before you chime in, I was just going to kind of make a comment. It continues to impress me how resilient things overall are. But we did see a decline in manufacturing jobs, and I know that you guys know I like to focus on the ISM report, which, for better or worse, I think is a very helpful gauge. But you can see new orders, another really ugly print on the manufacturing side. So the index came in at 42.6. Again, anything above 50 is expanding, anything below 50 is contracting. So new orders contracting. The headline all-in composite contracting at a higher pace than the preceding month, and now contracting for 7 months straight. The prices piece, though, that is a nice thing, month over month, a big shift in prices decreasing. So, the manufacturing sector, going back to what I was saying earlier about, construction is still really strong, and construction with these interest rate hikes that we've seen since last March, one would think this far into the hiking that construction would have started to shed jobs, perhaps. But the fact that construction is at all-time highs, that's why I was positing the question earlier about how much of that construction resilience is being fueled by some of these fiscal programs, which I guess if you're wanting to see a resilient economy, then it's good in one sense that the spending is happening and the resilience is there. In the other sense, it's that's a lot of deficit spending. So yeah, just some thoughts on manufacturing. But Mickey, you came up, and Jiro, I see that you did as well. So Mickey, please chime in and yeah, go ahead.
Yeah, first of all, thanks so much for having me up and great space, really great conversation, learning a lot. I'm sort of looking at things and trying to figure out what is really scaring me. Like people are talking about CRE, but it seems like a sort of slow motion train wreck. The one thing people are talking about, which I actually don't understand, and I would love some help and guidance on it, just understanding it in simplest ways possible, is people are talking about this M2 money supply issue that the Fed is going to need to raise a bunch of money to pay its bills, and that represents some sort of risk. But I don't understand what the risk is, and I don't understand why people are worried about that. I don't know if you have any thoughts about that.
Ooh. So you're kind of talking about Mickey replenishing the Treasury account
Yeah.
now that it's run down. Jiro, I know you're probably have a good comment on this. I see your hand up. So go ahead.
Yeah. Hi there. First of all, yeah, with M2, it's if I explain easily, it is just basically because of the TGA, because the TGA was drawn down. I think not to zero, but I think around 20 billion, if I'm not mistaken, right? And this needs to be filled up, or it is expected that they might fill it up between 600 and 800 billion. And plus you have QT, 95 billion a month. And basically when you have less when you have less money in the system, then less money is chasing basically prices, right? And automatically, the assumption is the prices need to come down because there's less money to buy. How do you say it? To buy a stock, basically. If you have an economy where we have, I don't know, let's say $2 trillion, in the economy, and we are chasing stocks, and you half it, right? Then automatically, I mean, it's not automatic, of course. It's much more complex than what I'm saying here. But the basic
Can
assumption.
I ask some follow-up
Yeah, sorry.
questions? Just can I have some
Yeah,
follow-up
sure.
questions to sort of see if I understand what you're saying? So basically, the Fed has an issue with they need a bunch of cash into the bank, basically, and to do that they need to sell a bunch of bonds, and they need to find a bunch of people who are willing to buy treasury bonds, and that money is going to go into an account so the Fed can pay its bills. And so right now the Fed is
The
basically paid.
Treasury. The
No, sorry,
Treasury,
I'm
not
sorry,
the
the
Fed.
Treasury.
Yeah,
I'm
yeah.
sorry, the Treasury. Yeah. So the Treasury needs to. So wait, then now I'm confused. The Treasury is going to sell bonds?
Yes, it's correct. The
Okay.
treasury finances itself, right? In two ways: it can get taxes, and it also can issue bonds, right? And that was also the reason why actually there was speculation and there was a little bit of criticism, right? That Republicans could have negotiated it longer, that this 20 billion might have been enough to get until June, was it June 13 or June 14? Because that was the next time where the tax revenues, would come in from certain states. I'm not sure anymore. Is it California maybe or something? And this would have brought enough money for them to actually have enough money until end of August, if I'm not mistaken.
It's California.
Is it California? Okay, I see.
Mm-hmm. There's a disaster delay. Like you don't have to pay tax until like October for most parts of California. So that's why they're short of money.
Okay, so basically the Treasury needs money. They sell bonds. They fill up their account with a bunch of cash. Now they can pay things that the government needs, the military, etc. So, and you're saying that in the market, people are gonna be more likely to allocate their capital towards the purchase of these bonds and not towards stocks, and that can create a scenario where there's either a tightening of credit or there's some impact on the market with all this money kind of needing to be sucked up by this giant vacuum cleaner of the Treasury issuing these new bonds. Is that the scenario
and
people
bear in
are
mind,
evaluating?
It's just tiny word choice difference that the Treasury is likely to sell a lot of bills. Remember, anything that's up to 52 weeks is going to be a bill. And from what I've understood, that's what both kind of bank analysts expect. And what I saw a story yesterday that I guess from the communications between Treasury and folks in the market, the bankers, that it's going to be mostly shorter dated bills that Treasury is selling as opposed to longer dated notes or bonds. But going back to what you just said about kind of it being tightening, I know that this is a week-old story, but both Goldman and B of A are of that view that it reduces liquidity from financial markets, and B of A noted they perceive the impact being a 25 basis point hike from this action.
Okay, so and then that would be sort of in line with what the Fed has been saying, which is that they're hoping that, or not hoping, they're saying that one condition in which they wouldn't raise rates is if they see significant credit tightening. So this would be sort of along the quote unquote master plan, if you can call it that, of the Fed, which is to say we need to take some air out of this balloon. We pumped a bunch of money in the system. It needs to come out one way or the other. Either we are going to force it out, or hopefully the market is going to force it out. And that's kind of where. So is this scenario people were discussing, that so many T-bills will be put on the market that it'll basically put a thumb on the scale and create havoc in the markets, and that's why everyone's freaking out about it? Or do you think it's not worth panicking over this increase in T-bills and this need for M2 money supply to go back up? Sorry for asking dumb questions, but I just don't quite get it. So
no,
just
I
asking
think
the dumb ones.
it's
I don't think they're dumb questions. I most certainly don't have all the answers to your questions that I don't believe are dumb. So I guess it depends on what is important to you. If you're a market participant, with a very short horizon, all else equal, one would think this liquidity headwind would be a dampener on asset prices. From a fundamental value perspective, it shouldn't impact the operating businesses in any way. But
why is
I get
that?
that's not what you're asking, right?
But why is that? Because if the supply of T-bills goes up, shouldn't the price go down? And wouldn't then assets be a better bet in the short term?
But you mean again? You said if more T-bills are issued, right? Then
Yes.
exactly. Then it's less attractive. Prices go down. Yields go up. Exactly. Yeah, that's correct. I just wanted to add one more thing, Mikey. Maybe with respect to M2, right? So basically, liquidity. I mean, why it makes a difference if they issue T-bills or if they issue 10-year bonds or 30-year bonds is because if you issue T-bills, it's basically like cash, right? So you don't, if I understand correctly, then you don't necessarily take the liquidity out compared to, I mean, if the treasury issues a 20-year bond, let's say, right, then they pay the money back in 20 years, right? Whereas if they issue bills, then they will pay it back in, I don't know, if it's a 1 month bill, then they pay it back in 30 days, right? So this is counted as not so restrictive on the liquidity, and that's also how do you say, why they're actually doing it. Maybe one more thing with respect to liquidity. I heard if they do reverse repo, so if they issue.
Yeah, I was gonna.
Perfect.
So Giro,
Sure.
I was gonna read a
Yeah.
quote. This is a Financial Times story from yesterday, quoting Deutsche Bank, George Saravellos. I don't know him, but quote. It basically depends on who buys the T-bills. If money
Yes.
market funds rotate their holdings away from the Fed's overnight reverse repurchase facility, the RRP, right, then the net effect would be neutral. So if it's just money market funds buying the bills, and instead of the money sitting in the reverse repo, it's now sitting in these bills, and it'll be neutral on liquidity. If bank depositors buy treasuries, this will lead to a liquidity withdrawal. We would argue that the former, the neutral effect, could be just as big as the latter, negative effect, leaving an overall liquidity impact that is far less than headline numbers suggest, unquote.
Yep. Right.
So I mean,
What is reverse repo? What is reverse repo? What does that mean?
I mean, a repo is basically you borrow money, right? And you always give a collateral for it. So let's say I do a repo with you, Mickey. Yeah. So I want to borrow money, but for that you ask how do you say, you ask for collateral, and let's say I give you a T-bill, and you borrow money, and then I have to give you back the money plus the 1 month rate, right? And this is basically what a repo is. Uh, the only reason why it's called reverse repo, if I understand correctly, is because I always get it wrong. It's either it's either it's either that the Fed. Yeah, I have to look it up. Basically, a repo is how to say, a reverse repo is exactly the same as a repo, but it is just because the central bank is issuing the collateral or something. But let me check before I say some dumb.
So yeah, Giro, I'm going to admit my ignorance on this one, and I'm going to rely on what ChatGPT had to say, that in the reverse repo transaction, the Fed sells the bills to a counterparty. That bank or money market fund, whoever, has an agreement to buy them back at a higher price, inclusive of the implied interest rate. And then it allows the Fed to absorb those excess reserves from the banking system, putting upward pressure on short-term interest rates. Those counterparties would be banks, money market funds. So in essence, for this whole TGA thing, it's who is the counterparty? Is it mostly money market funds, or is it mostly bank reserves, I think?
Okay, so the question is basically, if it's these reverse repo, you're kind of just rearranging, like, basically the balance sheet. You're basically swapping out with the same parties with a different coupon. But if it's retail, they're taking money out of a system that wouldn't be there anyway. And now if there's a huge flow of, like, say, retail capital, people from banks or whatever institutions, whatever, sovereign wealth funds, whatever, then that money, then it's zero sum, and that money which could have gone to Apple is now going to go towards T-bills for whatever, for 6 months or a year or
But,
however long.
but
And
but
that's
that assumes that the entire pot was directed towards the stock market rather than the rest of the bond market, right? That's a bit of a reach, Mickey. So there might be a percentage of money that would have otherwise gone to the stock market, being doing a risk averse transaction and saying, because it's such a large issuance and it's going to bump up the rates, maybe suck it in and take some money otherwise intended to buy stocks to put it there. But it's got to be a much smaller percentage of the overall, whatever, 1 trillion or so that's expected to be issued. So it's not like the action is going to take $1 trillion away from the stock market. I think that is that's absolutely not possible. So the question is, what percentage is really going to be taken out of the stock market? And my bet is it's going to be a fraction of that. Maybe 100 billion, maybe 200 billion. I don't know, but it's a smaller fraction of the overall number. So the impact, you have to adjust it down to that number.
when you calculate that. And sorry for, like, if I'm hijacking this conversation, but when you calculate that, what's taken out of the stock market, are you basically saying you think if there's a percentage of people who are going to sell equities and buy T-bills, or are you calculating at at a future date, we would expect a certain amount of liquidity into equities and a certain amount of liquidity into treasuries, and our projection now is we're gonna project now that future number that going into equities will be less.
So, Jiro, just give me. I'll respond quickly, and then then I'll shut up and you can talk. So Mickey, that's where this number gets smaller and smaller as you dig deeper, right? So there is money sitting on the sideline, whether that was intended for bonds or stock, that could potentially go into this big issuance, and they could absorb some of that. Then there is money outside the country. There's money that could exchange existing bills for newer bills. So there's a lot. When you start sizing it down, the impact to as a replacement opportunity for money going into stocks, now going into treasuries, is going to be pretty small percentage of that. Now granted, that could still be 100 billion or more, but but in the grand scheme of things, even the stock market is large enough, I think, to absorb that. And given all this talk about, it's 7, 8, 9, 10 stocks that are running, which I don't agree with, but let's just, for academic purpose, just say that. Who's going to sell their Apple to buy treasury? You might sell your existing treasury to buy newer treasury bills, or to roll it into a newer denomination, or maybe sell some of your other stocks, or other kinds of funds, money market accounts, whatever, right? So it's not a one-to-one relationship, and I think too much is being made out of it. By the way, I posted a thread up there that Bill put out. This is not the first time this is happening, and its impact on the market is just being overstated. So take a look at that.
Thanks, Manav. Jiro, did you want to add to that?
Yeah, sorry. Yeah. Just I mean, it's a very good question, right? Because a lot of people are talking about money in general, right? But how do you say? But we never think deeply about it, right? So I'm very grateful actually for the question, Mickey. Yeah, just one last thing, maybe. The problem is that there are different types of money, basically, right? You have the government money, basically, which are T-bills, you could say. Then you have bank money, which are bank reserves. And bank reserve, I mean, this is money and it shows up in the balance sheet of banks, right? But you would never be able to access any bank reserves. I cannot access it. It is only exchange between banks, right? So because when Citi wants to borrow money from Goldman, right, and they all do it interchangeably, right? It's a huge market, right? And but it's only accessible within the banking system. That's why it's called bank. How do you say? It's called bank reserves. And then for us, we have the real economy money, if you will, right? And the real economy money is the money with which we buy stocks, for instance. Or when we got the stimmy checks, uh, how do you say? You had a big asset price explosion, right? Because we really felt it. I mean, M2 is actually a terrible measure of money because M2 has been increasing forever, right? But the first time when we really felt it was when COVID hit, and how to say and we received the stimmy checks. I mean, I didn't receive it because I'm not American, but uh, but but it mattered out of the sun, right? Like people had more money in their bank account. It was not in the banks. It was not a bank reserve money. It was not government money. It was people's money, basically, right? And that's why with people's money, asset prices went up, and we got inflation. So, and I think this is a very important distinction, basically, right, between the different types of money: real money or real people money. Let's put it this way: bank money and government money.
Oh, that's actually super helpful. This is so, I mean, I'm just amazed and marvel at the magic and power of Twitter Spaces and the internet, just to be able to hop on and learn so much. I'm so appreciative. So it sounds like basically on a whole, we're really glad that the U.S. government is going to pay its bills that it promised, and we're glad it's way better. That's a way better scenario than M2 increasing dramatically, which is like something that's happened since basically for a very long time. And there may be impacts on the market, but generally the impact seems like it'd be overall stabilizing, and overall where people maybe most people probably be doing this reverse people, which is like swapping out their existing treasuries for newer ones with better rates or better coupons. And maybe some people might do something weird in the asset in equities, but doubt it would be enough to really put a dent in the market, is what I'm kind of feeling is the consensus.
Yeah, I think that's a good summary. And you probably have seen, I'm sure, people on this app, which the people that are voicing severe distress over TGA refilling are probably similar to those who've been voicing great distress over many other things in the preceding months. So it's not to say that it's a non-factor or non-event, but I think that what we're sussing out from this conversation is that it's likely to be far more muted than maybe those wolf criers would imply.
Yes. Well, I mean, it's like that because it's like next to something really conservative is going to be something totally off the wall, batshit, and it's equally in my feed. So I'm like, huh. Well, I don't know what this means, so maybe I don't know what they're trying to say. So it's really helpful to deconstruct the argument here. It's like very useful. And I guess my question for the panel now is, then I've struggled to see where we've heard recession for a couple of years. I have that. I'm a child of the great financial crisis, so I'm just like looking out. I have this huge bias towards everything is going to blow up, so I'm always sort of looking for that. And I look across the the U.S., where I'm based, and I are mostly based, and looking across various sectors, and I'm struggling to find. And my bias wants to find the black swan, the canary in the coal mine, but I'm struggling to see it. I don't know if anyone has seen it or has an idea or what they think is anything keeping up anybody at night or anything scaring anybody on the panel.
Well, if you can see it, you can hedge it. If you can hedge it, it's not a black swan. So it's it's
Yeah, that's a good one. By definition, if you can prepare for it, it's not. Exactly.
so look, if the government raises money, they're going to spend part of that money on IRA, part of that money on defense. That puts it right back into the economy, and that's directly going to, private companies and public sector. So it gets put back into the economy. It gets put back into salaries, and that gets spent because we are a consumption economy after all. So it again, there are real problems, Nikki. I doubt this is anything more than a potentially additional accretive problem. I mean, there's so many things that could break down, but again, data is so inconsistent on things breaking down that even if it is coming, it's coming very slowly, and there's nothing, just around the corner, unless, like you just said, it's an event that none of us can foresee, which case none of us can prepare for.
So, so to answer your question, Mickey, I mean, if there were one space in the economy in particular that's worrying me and makes me wonder what happens in coming years is all of this levered commercial real estate that has to be refinanced with the underlying values dropping in many cases. If it's downtown office and it's not, top quality office, I think that's an area. But again, it's not like it's a black swan insofar that it's known those prices. If you look at a lot of these REITs, if it's an LA or a New York REIT, a lot of them have already come down a lot in value. So I mean, it's not to say that it's not a problem and it won't have impacts on the economy. I mean, it also makes me question, the idea that have housing prices, because of the positive demand shock for work from home and all that, like will housing prices, be permanently at a higher level, and will therefore those office prices be permanently at a lower level? And it seems like that's probably got some truth to it. But yeah, Jiro, if you want to chime in on that.
Yeah, I'm just wondering because we talked about commercial real estate, and by we I mean how do you say, the market, for a long time now, and I'm just wondering if we are already pricing that in, kind of, right? Like, because it has been around for so many months already, and
Yeah.
when you look at REITs, they already trade at a big discount, right? Um, I'm just wondering, like, going back to today's. I removed it. I need to share the tweet again. Sorry. Today's NFP print, the edit jobs print. The problem is, it is such a noisy indicator, right? So the prediction is just done with other noisy stuff. So I'm not upset with the economists from all the investment banks that they are so far off, right? Because it is just, you are putting garbage in and trying to predict another garbage indicator. Uh, but surprisingly, I was very close, but that was just by luck and not because I'm better than them, for sure not. Um, but it's just interesting that economically something doesn't make 100% sense, because usually we were talking about for such a long time that in order to bring unemployment up, you need to have NFP print below 100,000. And why this magical number 100,000? It's because on average, 100,000 employees exit the labor force each month because they retire. So as soon as you are below 100K, you are basically you could increase unemployment, basically. So what is very odd is that we have this huge upside surprise, and we never had a print below 100, like in the tweet that I shared, right? The blue line is um, how do you say, the real NFP number, and the orange line is basically what it should be if if it was predicted with the other 4 features that I used. So it's much smoother. And as you can see, it's also terrible to predict because it's not like inflation, which goes up smoothly and down smoothly, right? Especially the year-over-year number. Yeah, so it's just weird that unemployment went up by 0.3%, right? From 3.4 to 3.7%. And Rod, I think we discussed the sum rule, right? So let's say in the next 2 months we have 3.9 and 4.1%. Because I think the sum rule says if the average of the 3 months is an increase by 0.5%, right? So if we have next month 3.9 and the month after 4.1%, then that would be the 3 months average would be 3.9%, which would be a 0.5% increase from the low of 3.4%, right? And I think the sum rule is saying that we never not had a recession, right? When unemployment increased by 0.5%. So that will be very, very interesting to watch because it's not impossible. Because I'm very surprised about this increase in unemployment while NFP is so
So,
high. Yeah?
so, Gero, the problem with that is we don't have too many precedents when we are starting at such a low base. So when you are, look, 4.5% would have been full employment. We are so far below that. So the question is, does that rule really work at such ridiculously low numbers, or is it still, I mean, job openings, for example, went up last 2-3 days ago when the data was released. So again,
Which is lagged by another
yeah,
month,
of course,
but it's valid
yeah, of course.
point.
Yeah, so I struggle to see how going from 3.4, which was the bottom, to 3.9 would indicate, a recession when 96 out of 100 people are gainfully employed.
Yeah, I agree with your
Good
sentiment,
point.
Monative, and I don't think Giro is necessarily saying the Psalm rule, if it does
Yeah,
that,
it's not a
in his
magic rule.
view,
It's
is
just
going to play out
historically.
that
Yeah.
way. It's just right. Yeah, exactly. That rule has historically held true, and as with so many other things, this may end up being the first time that it doesn't. If I think it gets back to your point at its core that you need to see a deterioration in NFP results. To that level that you pointed out, whether it's 100K jobs being added, to actually show that we're not adding jobs and we're starting to see a reduction and that there's that deterioration that's taking place. You can't enter a recession without seeing the labor market deteriorating. It doesn't really
Yeah, I mean, usually
pass muster.
The problem just with unemployment is that that in every MBR recession, which on average the MBR needs 7.5 months until they declare a recession, right? So after a recession started, on average, 7.5 months later, the MBR declares an official recession. During the financial crisis, they were 12 months late, right? So 12 months after they start, they declared the recession actually. So the problem also with unemployment is that often it actually starts month into a recession, right? And by month I mean like half a year into it, right? So I know that unemployment is a very important indicator in order to determine a recession, but it is such a terrible it is just not a leading indicator. It is just super lagging, right? So we will only know after the fact, unfortunately. And that's, I believe, the reason why everybody's looking at initial claims as a signal. But initial claims still look okay, actually. Just a sentence on the rate hikes, because Monetiv, because I think we disagree here a little bit. Because I believe that the Fed has a good chance, a very good chance to put in 2 more hikes Why? Because the problem is the next inflation print on the 13th of June, so for the month of May, will be very low, and then the June print will even be lower, right? So I think the Fed should make use of it, because as soon as the July data comes in, it will go up again because of negative base effects. Because then energy prices were really low. And if you remember the headlines last year, was it July? Was when Biden said in July that inflation was zero, because the month inflation that month was really zero, right? So and that is basically the end of the base effect. So I think it is better to get two mini hikes in quickly, because for instance in Australia, the bank, not the Bank of Australia, I think it's called how do you say it? The Royal Bank of Australia, they actually declared a pause, I think 3 months ago, right? And everybody was expecting that the top was in, and then they waited, and then they saw, okay, inflation is picking up again, especially wage inflation, so they had to raise rates again, and that increased volatility so much, and how do you say, the pricing of rates was extreme. So I think the Fed would like to avoid this and would rather be 100% sure that they don't have to raise it again, and I hope that they raise it, but we'll see.
Hey, Jero, I'm sorry if I'm mispronouncing your name, but you said
No, all
to.
good.
I wonder if you said to raise the rates quickly and then lower them. How quickly do you think they will lower the rates if that was the case?
No, I don't mean lower. Sorry. I mean to then basically keep the rates at that level, right? So they have a chance to raise rates by 25 basis points at the next two meetings, and then inflation will, if they are lucky, in June they might have inflation close to three, or even with a two handle, right? It's possible that inflation comes in for the June data. That would be middle of July, 2.3%, 2.5% if they are lucky, right? And but the problem is that July will definitely be higher. It's just because of the base effect, right? And I think in order to prevent the market to panic, right? I think it's better to get the hikes in now, to bring inflation down even more, right? Until June, so the market is not, how do you say, not that shocked, that inflation will pick up a little bit again, right? So I think if you act early, then it always makes a difference, because when you look at Brazil, they hiked super early, and they didn't have so much inflation problem compared to developed economies, right? Like in Europe and the US. So acting early makes all the difference.
I'm just going to make a comment. One thing that I've just been blown away by is how we have a VIX that's dropped, the volatility for equities, at least by looking at roughly 1 month on S&P 500 futures, whereas the MOVE index Treasury kind of expected volatility is still just extraordinarily high. So the spread between the two is pretty extraordinary. I don't know if it means anything, but just something I've seen today when you see the headlines about VIX dropping to the lowest levels since 21. Pretty incredible.
Yeah, but Rod, if you how do you say? But you are a fan of put options, no? So it's much cheaper now to buy them, no?
Well, they've also happened to go down in value.
Fair point.
Thanks to the underlying. But Mickey, I saw your hand up. Please chime in.
Yeah, I'm just trying to reconcile sort of the narrative and the sentiment that at least I feel like has been there for the last 6 to 8 months, like in the media and on this app and others, which is this quite bearish sentiment. catastrophically bearish in some areas. And I just wonder if it's all down to the fact that over the last
Most
10 to 15
investor
years,
surveys I've seen don't show that, by the way. So
that's
I would be
so interesting.
cautious. I would be cautious to read too much into what you see on your Twitter feed.
Okay, so that kind of brings me to my point, which is that like the people who have started to establish the megaphone in social media and in, let's say, like maybe in traditional media as well, but not so much the stuff coming out from banks and analysts, but more for retail focus. Like the people who have gotten the microphone are the people most vulnerable to a change in cost of capital, like the people who whose businesses made sense when money was free, which is basically every business. Like you just think back in like finance, if you made the WACC zero, you could justify just about anything, like monkey picks.
You're cutting out there, Mickey.
Mickey, maybe I lost your audio too, so maybe step down and come back up. I don't know if it's your connection, but one thing I was going to just correct myself. I misspoke. I said VIX is to the low since 21. I meant to say actually it's lower than it's been since pre-COVID. We are now at the lowest VIX reading. And second point I was going to make, to Mickey's comment on bearishness or the perceived high level of bearishness from, say, the app. I'd made this point on Wednesday. The Investors Intelligence survey shows bears at the lowest level since January 21. So that's just one of many investor surveys, but you're at 20. I just pinned that one. Helene Meisler tweeted it out earlier this week. So, there's definitely bearish narrative and bullish narrative on this platform. And I'd just be careful to read too much into what you see on your own feed and try to look at standardized sources or sources that have been going on for a long time, like some of these different surveys. Which it seems like bullishness is more the take from what I'm seeing there, but doesn't mean anything. Doesn't mean it can't keep going. Jiro, yeah, go ahead.
Yeah, I just wanted to add, I forgot to say it before, that where Monetiv and me agree actually is that the likelihood of a soft landing is not small at all actually. Because the problem is usually that when inflation is so high, in the history of the last 200 years, you need a recession in order to bring it down. And it seems as though the Fed has a very, very good chance, and Powell has a very good chance to go down in history, actually. So if he lands that plane, he will go down in history and his Volcker level. He will top Volcker, in my opinion, historically. And I think also the focus, to keep the focus on inflation and not to because the market was talking about the pivot now for 18 months, and maybe also a question to all the other speakers, because we were talking about a lot of Twitter opinions. So if a person predicts an opinion, predicts a recession, but predicted it already 18 months ago, and he's repeating it over and over again, and he's postponing it every 3 months, and every quarter he's like, okay, then it's next quarter. Would we still say that he predicted the recession if, let's say, the recession starts in 2025? Okay. I see.
I'm
smiling.
gonna refrain from a tongue-in-cheek response
Exactly.
because I think what my response would go along the lines of.
No, I'm just saying.
Come on.
Yeah.
That's exactly what's called for here. I mean, Jerry, this is an excellent point, right? Look, if you take away, let's go, let's zoom out a little bit, right? If you take away the COVID period and normalize it back to where we were pre-COVID, we are, the data starts to make a little bit more sense. We are slowing down. The slowdown has been, happening for a while, and there's plenty of data to suggest that we're slowing, that slowdown might accelerate over time. But we also have a lot of things that have changed. Again, leaving aside COVID, right? We have these geopolitical headwinds that have changed. We've had, a lot of non-COVID incentive money thrown into the market. We have, potential, probability that China might come out of it sometime or be forced to do more incentives, just to keep out of, riot on the street situation there, right? It's getting pretty ugly. The 21% youth unemployment is beyond Spain during the financial crisis. So there's lots of data to suggest that we are normalizing back to pre-COVID levels, and things are slowly going down. Question is, like you said, right? Where is this landing going to happen? How is it going to happen? Do we have enough data to suggest it's going to be a sudden abrupt landing, or is it going to be a gradual slowdown? I personally don't see anything to suggest that we're going to come crashing all of a sudden when there is so much incentive still swashing all around the market. Where is the okay, maybe the stock market itself might, have some, big changes because of, slowing down in earnings or missed projections, things like that. But the economy itself is still in good shape. It is slowing. You have excesses in one part of the economy being pushed into another part of the economy where you had massive deficits, right? Tech employment is a great example. Even if you assume that there was a lot of underemployment in tech, which I believe very strongly, 2 years of over the top extreme hiring, which was completely uncalled for, there was also an inability for the entire industrial complex or the entire non-tech complex, where the demand was tech workers was massive, but they were not able to compete for that talent. Now, all of the people fired, if they want a job and they're willing to, take a little bit of a hit, they have a job available for them to take. So I guess in a long-winded way, what I'm trying to say is, people who called for a recession 2 years ago are just wrong. Forget about whether they will be right. It's a whole different cycle. We are well past the point where we can give them some credit for having called it. I think it's meaningless at this point, right? We've gone through a cycle of inflation, a cycle of employment rates, a structural change in the economy, geopolitical mess, a whole, big up and down cycle in energy, and we're still here. We're still nowhere near a massive downprint in GDP. We are getting a downprint and then an upprint and then a flat print, right? So there is nothing consistently out there to suggest that the calls so far for a recession are anything but laughable, right? Whatever the reason for it, it's just the call just was not right. Eventually, yeah, there will be a recession because we need to, wring out the excesses in the economy, and there's really, no other way to do that, effectively. But it'll be a completely new call at that point in time. I don't think, I'd give any credit to people that called it. Even the people that are calling it right now, if it comes 7 months, 8 months, 9 months later, was their call right? Really, if people could look out 7, 8, 9 months, they'd be billionaires if they can put their, if they can wager based on their calls that way. Unfortunately, nobody can do that. What's his name? Mickey was saying, there could be a black swan that actually takes us into a recession that we don't know anything about today. So Actually, Jiro, Bill and I have been talking, behind the scenes here, not during this call, but earlier all day today, from out of different